Hello, everybody. Welcome to Friday, another show of Talk Money with Tom. And we're really, enjoying these shows as a whole. This is a great format for us all together. Love to answer questions. Really big emphasis here to try to increase investor education. We believe that the more that you know about tax planning and financial planning, investment management, the more your wealth can build. And so we really enjoy the questions coming in. So what you want to do is you just want to send in questions to Ask Tom at talkmoneywithtom.com. You can see the address right there on the screen. And then Katie here is going to be receiving those questions. She'll be our moderator and ask the questions that come in. And then Eason, who you'll also see here, is another one of our advisors. And you can ask him questions directly also, but otherwise he'll maybe come up with some follow-up questions. Katie can come up with some follow-up questions. We'll try to kind of build out each one of the subjects. So I will say one of the things we're doing is we're constantly putting new educational videos on this particular channel that you're looking at right now. And so if you want to see those as they come up, you're going to want to subscribe and then hit the little bell there to get the notifications so that when we're posting these. And I've been encouraging people recently to try to share these videos with their friends and relatives and coworkers, just as an object to be able to try to help everybody get farther along in their knowledge in these areas and help them build their wealth also. So something really excited about too. So I think what I'll do here first is I'm going to start with kind of a summary of what I see as the most important things that happened that I think are affecting the stock market. One of the big pieces of kind of getting ready for your retirement, for example, and working through your retirement is making sure that your assets are doing what they need to do. So we put out a daily video, a market update, which kind of gives you a good feel for what's happened that day, but also I think it's educational. You start to learn what's important about the stock market and where do you get your emphasis from. So today we're going to talk about what's really important this week, which really has to do with jobs. And so I'm sharing a chart here from Market Watch. The jobs report just came out today, and so there was 850,000 jobs created in June, which is a really good number, actually. In the world of the investment world, when the market is looking at job growth, it likes to see a certain amount of job growth, but not too much or not too little. We call it the Goldilocks zone. And 850,000 jobs seems to have made the market quite pleased today. But you can see what happened here. We had a tremendous amount of job loss during the shutdown of the pandemic. And then, of course, we started to see some, recovery, and we've had a nice movement here. If we look at it another way, it's just a percentage of the population that's unemployed. And you can see here in 2019, we were essentially at around a little over 3%. We shot all the way up to almost 15%, but we've been coming back down. As all of these jobs have been added, we're back down to 5.9%. So one of the keys that I look at when I look at this is, first of all, which direction is job growth going? So it's obviously going upward right now. We're recovering. That's very important. But then secondly, once we start to get really low down here, there's some potential inflationary pressure. And so that's one of the things that the market's worried about right now is that, if you don't have very many people looking for jobs, you would end up with a situation where you have to pay more for each one of those employees. So that's creates inflation. One of the biggest costs that go into product is a person's, labor and such too. So here's another way to look at it. This came out of the New York Times. This is from the Bureau of Labor Statistics. Shows the number of jobs that we had prior to the pandemic, the big loss of jobs in total by April of last year. And you can see we fairly steadily recovered those jobs, but there's still 6.8 million less people working right now. So there's still a long ways to go. We have and the Federal Reserve has been very focused on trying to keep their policies for easy money in place in an attempt to get these people back to work, as far as that goes. But here's something incredible that's happened. Even though we have 6.8 million people less working in the workforce right now, we've actually been able to move the gross domestic product. Okay, so this is the total production of the country, which you can see has been growing very nicely and then fell very heavily during the pandemic. But we're actually all the way back to where we were before the pandemic. So essentially, we're producing as much as we were, actually a little bit more, with less people. That's why the market's doing so well, because if you can generate the same amount of revenue with less labor, you're going to have more profits. And so those profits are driving the market. The S&P 500 is up a little over 1% so far for this week. It's gone up every single day. We've been hitting new records every day. That's because we have high profits coming out of this situation. So imagine what's going to happen as these people start to get back into the workforce and we start to absorb that 6.8 million. We're going to continue to see profitability, mainly because we should see some economic growth as those people start to make more money and what have you. And so here's the most fascinating thing, though, about this whole week, and that's this chart here. This is the number of job openings. This is going back to 2018. You can see there was roughly 7 million job openings, and then it dropped. But look at this. Right now, we've had this big run-up in the number of job openings. So there's 9.3 million open jobs. So think about that for a minute. 9.3 million open jobs, and we've got 6.8 million people that are out of work. Doesn't make any sense. And so Indeed, which is a job search, website, did a survey, and what they found is only 10% of the people that are unemployed are currently looking for a job. So that's kind of surprising. And in that survey, they asked why. Number one reason was people were afraid of the virus. So a lot of the jobs that were lost were really lost in the areas where there was a risk of catching the virus, at a restaurant or a hotel or these indoor type places and what have you. So that's number one. Number two is really childcare, which also relates to the virus. And so, if you have a child at home that you need to care for, it's hard for you to go off to work unless you have daycare or school, both of which have been somewhat compromised by the virus. And then the last thing, and this is coming from the politicians and the press, which is just, hey, everybody's getting $300 extra a week by being unemployed. Maybe they don't want to go back to work. And so, all of these things are probably resolving themselves this fall. The extra unemployment drops off in September. Hopefully schools start to reopen and that creates a situation where people can go back to work. And maybe as more vaccines come in and people get more comfortable with what's happening, they become a little bit more secure about, going back to work in terms of the risk of the virus. So really fascinating as far as that goes. This week, is jobs week because of these reports that come out this week, and you can see the market kind of responding to that. And really, we've seen some decent, returns from the market, especially in the large growth area of the market, the tech stocks and those things. And a lot of that has to do with the fact that the market seems to be pretty okay with the job growth that we have going on right now. But the key issue for the market going forward will be the threat of inflation. And so this is what I would focus on if I had to look at one thing that had related to the job market. This shows the average hourly pay. And it basically looks back 12 months. So how much is the average hourly pay now versus where it was 12 months ago, and how much is it higher or lower? And so what you can see here, so you look back 2019, over a 12-month period, wages were growing at about 3.7% per year. That makes sense. And then actually wages grew on an average basis during the pandemic, which seems really counterintuitive until you think about who got laid off, which was low wage people. All right. White collar wasn't as affected in this particular downturn. And so that was when you're left with higher wage people, the average pay is going up. So that's sort of an anomaly. You can kind of ignore that. What you really want to pay attention to here is this recovery that we're having. And so we're currently at 3.6%. This June versus last June, there's 3.6% higher pay per hour on average across the country. That's right in line with where we were. That's perfect. That's the Goldilocks zone. But where does this go? Right? Does this stay and start to go sideways here, stay at around 3% growth, month over month versus last year, or does it go up a lot? And so this will be a really big area as far as that goes. And so that's one of the things I would focus on. Those are the things I think are important. Right now, the numbers look really good. And, you don't want them to get super good in terms of these numbers just because that can create inflation, which can bring the market down or at least cause volatility. It would like to see this kind of even recovery. And so one of the things that's contributing to the even recovery will be the global recovery. Here in the U.S., we've had, you can see, a lot of job growth. A lot of things are coming back around. A lot of vaccines been distributed. Things are reopening. But that's not quite true, when you look at the rest of the world. One of the things you can look at is what's called the mobility data. So this is tracking, how many, cell phones and how much they move. And right here now in the U.S., the mobility data is negative 17%, which just means that people are moving about 17% less than they did February of 2020, so before the pandemic. So there's still some room for growth because movement is associated with economic spending and growth. Part of that movement might be people not going to work, those types of things. So once they start getting out and going to movies and going out to restaurants, things will grow. But if you look at the globe and you look at all the major countries where they're tracking mobility data, it's down maybe 25 to 30%. And so there's a lot of room for growth. Australia just locked down again, and they're only at 8% vaccine rate. So as that starts to develop and as those things start to reopen, we'll start to see international travel. So there's a whole bunch of things that could happen here to really create a good economy. And so we'll have to see, if it grows too fast, too slow, or just right. And that's what we're looking for in terms of the market. So really fascinating week, actually. And this is just an incredible time period. I think the market is a good place to be right now with where things are going. And, the Goldilocks zone seems to be, happening for us as a whole. And we're starting to see some fairly consistent gains. So, really look forward to kind of seeing what's going to happen, next week too. So, um, I'm going to get back to the Q&A session here. So hopefully we have some questions that come in. Again, it's never too late to send in a question. Ask Tom at talkmoneywithtom.com. Send them in and we'll try to answer them as best we can. You have anything in there yet, Katie?
Yeah, we've got a couple of questions in about retirement. So first off, I am approaching retirement. What kinds of things should I be looking for in preparation?
Okay, that's a great question, actually, because here's my outlook on finances as a whole. There's it's essentially goal based. If you really look at it, right? We have a current lifestyle that we're trying to meet, and then when we're looking at kind of the future, it might be, trying to save for a car, save for a house, pay for college education if we have kids, all those things. But I'll tell you what, the big granddaddy of all the goals is retirement. It takes the most money and it probably is the most gratifying, honestly. Getting a house is great and everything, but having a fantastic retirement for the last 20 to 40 years or 50 years of your life is just, it's unbelievable. And for the most part, what I've seen within my clientele, people like retirement. Matter of fact, the most common comment is, hey, I should have retired a few years earlier. And so I think that's pretty good. So really what you want to, watch for and deal with in retirement. And now when I say retirement, it's still ongoing. You're 80 years old. You're still working on your retirement. You're 20 years old. You're looking forward to your working, and you're working on your retirement. We're all working on our retirement, honestly, at every point in our life. There isn't any one point in time. So, really, what you want to make sure is that you have your base is covered, that you've got a solid financial plan in place no matter what age you are, to drive yourself and to guide yourself for where you're going. That should be reviewed every 6 months. You want to make sure that you have a really solid asset management program that matches your risk that you need to take to make your plan work and the risks that you're willing to take, and getting those to balance out. That's super, super important. And that you make sure that you still have savings in place, even when you're in your retirement, but certainly prior to retirement, to be able to handle those different types of, you know, events that happen, just like what happened last year with the pandemic. We don't know what's coming next. And so being aware as far as that goes. I believe personally, and this is why we're pushing this so much. Look, I've done over 6,000 financial plans. I've been doing this for 35 years. I've gotten to watch so many paths, so many situations. I've seen good paths. I've seen bad paths. And I think that knowing what we're talking about here, becoming more knowledgeable about financial planning, tax planning, investment management, even if you've hired somebody else, like me or somebody along those lines, still you're going to do better. And I've noticed that within my clients. So that's why I think, this type of resource, we're providing a free education. There's literally millions of dollars worth of content that we're putting out here. If you really paid attention and followed along, it could really make a difference. So I think that's the kind of the other part is you just never stop learning about it. And find some interest. You don't have to get to my level, but picking up pieces here and there will help you tremendously.
So in the beginning of your question or your answer, you mentioned the importance of having a financial plan and reviewing it every 6 months. What age would you suggest for someone, let's say 18? What age would you suggest starting that financial plan?
I think in your 20s is a good place to start a financial plan. And even any point in time when you really kind of get that first, significant job, because I think it does make a difference. It gives you a guide path, to follow. That's not very common, but I do have that. We do have clients that have done that. Obviously, if you look statistically, most people save most of the money for their retirement between the ages of 55 and 65. And that's when they start to get serious. And a lot of people don't do a plan until they're really, really close to their retirement. But I think that's a mistake. I think it would help you substantially to be able to see the future if you had that in place. So, yeah, I don't know that you can do that too young. It wouldn't be a problem.
Yeah, and the nice thing about a plan is that nothing's ever set in stone. So, say life changes, say you don't want to buy the house in California anymore, but you're moving to Michigan for a job, and your plan can be easily adjusted. And so having a flexible plan is always good.
Yeah, and that's changed. That's a new concept altogether because if you think back to when we used to do plans, well, first of all, we used to do plans. I go farther back than you guys do, but on a yellow legal pad with an HP 12C calculator, right? So those weren't maybe the best examples of what you do. And then the next version of plans was this big software, and we had to gather all this data. It was really hard. We were lucky if we could do it every 2 years just because of the pure labor. But now plans are live, they're online, all of the assets are linked into the plan, and it's super simple. Literally in a few minutes, we can go through and update some of the goals, for the changes like you mentioned, Eason, and we're able to run a Monte Carlo simulation and see what's happening. And that's changed the whole world in that regards. And it's a dream of mine. I mean, I've honestly thought about this for so long, being able to have live active plans for every client, and now we have it. It took a while for the technology to get there, but yeah, exactly that flexibility of seeing, hey, this changed and that changed, and how that impacts your life, or hey, asking what ifs. What if I want to go do this instead? What if I want to switch jobs? What if I want to take these big vacations? Or what if I want to remodel my house? Or so to me, that's a huge issue, right? Because now I've got, let's say, a 70-year-old that's in retirement and they're no longer earning money in a job, and they've got these big questions and they want to do something. They want to remodel a bathroom. It's going to cost $100,000, or I don't know, whatever it is. How does that work? So that's really where the flexibility of a plan comes in today. It's really, really powerful.
So we've got another question in from Byron asking, what are some mistakes you have seen some clients make that you want to warn others about?
Okay, I'll give you a story actually because it's kind of interesting. I had a client who came in, actually got laid off in the 2000 downturn, kind of like middle management in a tech company, was making a lot of money, like 250,000 a year, had a nice home in a nice area, but really, didn't save much. Maybe had about 250,000 saved, and was still pretty young, 57. So, but at that time, it was really difficult to get a job in the tech business because the whole tech arena had exploded, and couldn't find a job, and they really were hiring younger people at that time too. Uh, so he basically decided to retire early, which was a bit of a problem because he didn't have a lot of money saved, but he did have a very nice home with some good equity. So he sold that home and he moved into a smaller place here locally. The problem was that he and his wife continued to live the same lifestyle. So if you're trying to live a $250,000 lifestyle, you're going to need a lot of money. I mean, way more than he had. And they just didn't have flexibility to make an adjustment to their lifestyle. And it's sort of a mental flexibility. It's something I'd work on prior to retirement. Because once you get into retirement, things aren't that certain. You know, you might have a pension, you might have Social Security, and some of those things might be pretty stable. But the rest of the things in the stock and bond market, I mean, even the banks, right? The bank money is stable, but it used to pay 8%. Now it's paying 1/4%. So it's that's not stable either. So having that flexibility to adjust your lifestyle, because this couple would come in and I'd get out my calculator and say, hey, look, you got 3 years worth of money left, at this rate that you're spending. And then they come in at 12 months worth of money left, and they eventually spent it all. And then they sold their place here and moved to Minnesota to get a cheaper place, capture that differential. And that's where I lost track of them. But that story happens. People can get kind of addicted to their lifestyle and addicted to their spending. And so, if you're going to have a big lifestyle, you're going to need a lot of money. It takes a tremendous amount of money, especially with the variability of what happens out there. So I would say flexibility and making sure that you have that in place so that when there are downturns, you can just adjust and deal with it and make it a temporary situation instead of a permanent one where you've spent all your money. Because it's going to be hard to get that back, especially for this couple because they were pretty young. It was going to be a long time that they needed the money.
So is that why you always recommend that you pay off that loan, that mortgage loan before you retire, so you have that flexibility, try and get rid of all those big fixed costs?
Yeah, and if you can't do it before we retire, make it a goal. Pay it off a little bit extra. Get rid of it. Yeah, exactly, because it gives you flexibility. If if you have a $250,000 lifestyle and it's all variable costs, in other words, travel and different things that you at least have some shot of cutting down if you want to, and then you can be more flexible versus, let's say, 200,000 of that is locked up in things that you can't get rid of when things go south. Man, you got no flexibility. So yeah, exactly right. Create that flexibility mentally. I would say the mental part of it's more important. I've seen more trouble with mental, and we all see this. We see, people with health problems that can, smoking isn't going to kill you. They keep on smoking, right? There's things that are hard to stop doing sometimes, and so spending sometime and overspending is a habit. But then structurally, you're exactly right, Eason. Creating that structure so that you have that flexibility. Things are good. Ooh, you can spend even more than 250 if that's your goal. But when things are poor, be able to kind of adjust that, and that's keeping that fixed cost, that structural fixed cost low. And if you can't get there in retirement, just keep working on it, because not everybody gets in the perfect situation, but just keep working on it, and it's possible to get there.
So when there is a downturn, do you suggest that people try and keep as much of their money that's in the market untouched and just not try and use that money?
Yeah, ideally, and not everybody can do this, but ideally, let's say you have a certain amount that you're taking out of your accounts every month and then the market falls apart. Uh, Ideally, you cut back that amount. And one way to look at that is on a percentage. If I'm taking 4% or 5% or 3% out, and then the value drops, maybe I just drop with that. That would be great. And let's keep taking 3%, for example. But, I went from $1 million to 750. So I'm going to have to drop my income, by 25% to make that work. I got to have that flexibility, both mentally, hey, I'm going to have to adjust what I'm doing, and actual physically within that structure. So yeah, no, it's something that would be perfect, is to adjust your withdrawals from accounts based on what's happening. And then maybe you can go the other way too. If it goes to $1.25 million, you can get a 25% raise as far as that goes too. So there's lots of different strategies on how to do that, but that's in a generic sense that would be a really good way to go.
So here's a question for Eason. How do I figure out the income needed for my retirement?
So when we do a plan, a lot of the times we just start with, what is your current lifestyle? How much money are you spending to have your current lifestyle? And then we try and figure out what costs will be gone from that current lifestyle when you retire. So a lot of people will pay off their mortgage. And so that's a big cost in their current lifestyle that'll be gone. And so sometimes people add costs, such as we want to travel more. We want to add $10,000 a year of travel. And so we try and figure out that current cost based on, use it as a baseline and then adjust with kind of their inputs, their goals and dreams and what we can remove. And then you'll have a rough estimate of how much income you need in retirement.
Yeah, it's one of the biggest issues. It's by far the most sensitive number within the financial plan is how much you're going to spend because it's a big number usually. And then, it's got to grow with inflation and those types of things. And, having done those 6,000 plans, one of the things that came up is oftentimes people struggle with that number. They don't know what it is. And they really don't want to sit there and dig through their checking account or what have you and try to figure out what they're spending. So one simple way to do it is to say, okay, I take home X amount of pay after tax, right? And just simply, so an after contribution to 401k or whatever. And do you save any of that or not? So if I take home 50,000 after tax and after putting money in 401k and what have you, and nothing ends up in my savings over a period of time, then I'm spending 50,000 a year. If 10,000 ends up in savings, then, I'm actually spending 40, all right? Because I'm building up my savings. So So sometimes there's some kind of macro ways to look at it and at least get kind of close. It doesn't have to be exact only because it's not going to be the same all the way through your retirement anyway. It's just a starting spot. And then that's why doing it every 6 months, you can kind of see what's happening and continue to look at that. And we can kind of tell, right? I mean, I know Ethan and I have worked on these plans quite often, and somebody says they're spending 75, but we're just watching, all the other things falling down, and that's probably spending more. So we make an adjustment, or they just keep, building up assets. That means they're probably spending less. So, you can tell over a period of time without having to break out the budget and do a line item thing and what have you. If you want to, that's great. There's nothing wrong with that, but there are some simple ways to figure that out. It is the biggest number in the plan.
Do you think people really start to figure out how much they need in their first couple of years of retirement rather than it's hard to predict when you're still working?
Yeah, here's the problem with that, though. I agree with that wholeheartedly. You really probably don't know for sure until you're into your retirement a little bit, but you're trying to decide to retire, right? And in order to decide to retire, you got to get at least a little close on that number because if you're way off, one of two things are going to happen. If you're overestimating how much you're going to spend, then you might think, oh, I can't retire. And you actually could because you're not spending that much, or the opposite. Oops, I retired too early and I really am getting kind of pinched. And unfortunately, you don't know that until you're later on in life. But so you do want to get kind of close to it. But really, yeah, it gets clear, much more clear as you go through the first few years of your retirement. That's exactly right.
So we have a question in from Kylie asking, I'm 24 and I have zero retirement. How can I get on the fast track to a successful retirement?
All right. Well, as I mentioned, most people save most of their retirement money from 55 to 65. So if I forgot the stat, it's really high. It's like 80% of money saved for retirement is in that the last 10 years. People are motivated and maybe their kids are out of college, those type of things. So it's a good time, they're making more money. So asking at 24 it's great. I mean, honestly, just because you're asking that question, you're probably going to be pretty successful. That's a great start problem because not enough people ask. Not enough people care. So I would say, Kylie, that the first place to start is a financial plan. And because again, these are fairly simple things to do. Even if you don't have assets, it's not about the assets. What the plan can show you is what you need to save to reach the goals that you have. What's your vision for your retirement? What age are you? What are you doing? Let's guesstimate what that would cost in today's dollars. And then let's go backwards and say, okay, based on, a portfolio that would meet your particular risk needs, what do you need to save? Does that make sense? Is that even possible? How would you do that? And what it does is it just gives you motivation. The fast track to retirement starts with motivation. You're not going to, that's true with a lot of things, right? I mean, if you're trying to lose weight, it's sometimes really motivated to see other people that have done it, right? So if you have a plan and you have a picture in your mind, and I always encourage people, at that age to actually get pictures. I mean, I have pictures all around my mirror. This house that I'm sitting in here, that you're looking at, was created out of a picture that was next to my, mirror. So that I think it starts with motivation. And that's where the financial plan can really, really help. And so that would be the fast track that I would think about is say, hey, because you don't really know. I mean, I put away $50, $100. I mean, I know what I can afford, but what should I be doing? And then how much should I be increasing that each year? And should I be using a Roth IRA or a regular IRA or a 401k or those are things you can answer in the financial plan and test out and see which one would work best for you and such too. So yeah, that starts with a plan. Create the motivation.
Yeah, but even if you don't have the time to create a plan, if your company has some sort of match, try and utilize that.
Yeah, no
You
kidding.
know, if they're giving you 3% match for that, your 3% of your income, like 100% match, that's a free 3% return or 100% return on that money already.
Yeah.
And so try and utilize match. If you don't have any idea what you're doing, match is really key.
Oh, it's a big deal. It's amazing to me how many people don't do the match. Because if they're going to give you 3%, somebody will say, "Oh, I can't afford to do the 3%." Well, honestly, even if you just did it and take the money out and pay the penalty and the taxes, it's free money. I wouldn't do that, but you got to think about it. The S&P 500 average is about, let's just make up a number here, 10% a year. So, it's a little higher than that, but we'll say 10. If you're putting in 3% of your salary and they're putting in 3% of salary, you just made 100%. And in order to make 10% in the S&P 500, you're having to go through all kinds of ups and downs and, pandemics and all these things. You're getting 100% from your company for no risk. That's how you create wealth. I would definitely be looking if you have and some of these matches are ridiculous. Working on a case right now with a match that's at 50%. And then, we have companies here in the valley, in Silicon Valley here, that are will match every dollar you put in there. 100% on a max. Wow, that's a huge number. So yeah, that's definitely, it's a good point, Ethan. Even if without a plan, just if you can do the match piece, if it's available, that would be awesome.
So we've got another question in here saying, I'm 52. I know I don't need to deal with required minimum distributions until I'm 72. Is there something I should be doing now anyways?
Yeah, that's a good question. So this applies to almost any age, actually, because even if you're past 72, what they're talking about is what's called a required minimum distribution. We call them an RMD. And so with an RMD, once you get to be 72, you have to start withdrawing money from your retirement plans, with some exceptions, and I'll describe those. But uh, and this creates a scenario where you could end up with a lot more taxable income than you really want, and that can have all kinds of ramifications to your financial life. And so starting early, you're able to kind of take a look at that. And so if you're if I'm 52 and I'm looking at that, I'm thinking, okay, matter of fact, I just did this. I'm 56 7. I mean, I was 56 when I did this. I'm 57 now, but I'm looking at my clients that are in their 70s and 80s, and I'm watching how much taxable income they're having to take out of these retirement plans. And some of them, it's a lot, and it's creating all kinds of havoc. It's increasing their taxes, increasing the cost of their Medicare, everything. And so one of the things to take a look at is, first of all, contributing to Roth type of an accounts, either Roth IRAs if you can, or Roth 401ks if you have one, because a Roth grows without tax and there is no required minimum distribution. So you don't have to take money out of those. And even if you did, it wouldn't be taxable. So that's cool. And I went through and converted my IRAs over to Roth IRAs, and I had to pay the tax on that. And that's very expensive. But long term, I won't end up with this kind of tax time bomb that I'm seeing within my clientele. So if I'm 52, that's one of the things I'm thinking about for retirement, and looking at the required minimum distributions is, how do I lessen that? At this point in my life. And even if I'm 82, I would be looking at the possibility of some Roth conversions if available. So, you have to do the numbers, you have to do a little bit of calculation to kind of figure that out. But I think that's what I would be looking at there is, what should I be doing to reduce my future tax liability that I'm going to be forced into at 72 and beyond?
Yeah. So when you talk Roth conversions, I know you did it while you're still working,
Yeah.
but most people tend to do it when they're just retired and right in before in that period before RMDs.
Yeah.
And what's the value of doing it then rather than when you're working?
The best time to do it actually is, let's say you retire at 65, and then in that 7 year period, you might be able to finagle it so that your taxes are pretty low. And then you would just add these conversions on top of that to bring your taxes up to where they would normally be, and that would create a lower tax cost in total across that, just across that conversion. So that 7 years, I've run lots of financial plans, and somebody's income's kind of high as they come in, into retirement, and then it tends to drop down because we can pull incomes from different places that are lower tax, and then it starts to go back up again at 72 and beyond because of these RMDs. So that little gap in there can often be a really good place to do some conversions. But it does have somewhat to do with your rate of return. That's what I do for a living. I have a really good rate of return on my IRAs. And so, I paid more tax than I would have by doing it in that gap, but I plan on making it up because that's the other disadvantage. I did it at 56. I would have had to wait for 9 years to kind of get into that gap. And unfortunately, I'm planning on work till 75. So that gap isn't going to even happen. But in a normal scenario, and so I'll end up with just a lot more money in those IRAs. So, but that it's a good point. It's a good conversation. We actually have a program that does a really good job of taking a look at the conversion process for Roths, and we can get a pretty good answer for what works when, and how that might benefit somebody. But if I'm 52, it's definitely something I'm thinking about. At the very minimum, though, I could at least start to contribute to the Roth type accounts, even if I didn't do conversion, right? So I'm not increasing my tax liability heading into my retirement.
Yeah, and when you do a Roth conversion, you need, or one of the calculuses you need to think about is, do I have money outside that
Yeah.
IRA to do that conversion, to pay those taxes that I'm going to incur by doing the conversion?
Yeah, that's the number one reason that people can't do it. And I've had conversations where it makes sense, but they don't have the money outside of the IRA account to pay the tax. Because if you move $100,000 and have to pay 20,000 or 25,000 in tax, you can't take it out of the Roth IRA. If you do the math, it doesn't work. You have to come up with that money from someplace outside of the Roth. And the way that it works, it certainly is that entire 100,000 goes into that Roth, and then you use some other assets. So yeah, that's a good point. It's one of the key impediments to doing it. But again, a 52-year-old, I'd still at least be contributing, my monthly or yearly amount that I'm putting into those types of accounts into a Roth type account, Roth IRA or Roth 401k if I had it available, instead of a traditional 401k or a traditional IRA. I would still be looking at that to at least mitigate what I could.
I noticed that the interest rates on the 10-year treasuries are dropping. What does that mean?
Yeah, it's very fascinating actually. So, the 10-year treasury was up to about the 15% rate. 1981, I think, is when it hit its high. And it's been working its way down ever since 1981. Lots of little ups, but it's been basically going down. And we hit an all-time low in August of last year at a 0.5%. That's amazing, from 15% down to 0.5%.
Wow.
And so the 10-year treasury is a really good measure for a couple of things. Number one is potential future inflation. So, and lo and behold, in that time frame from 81 to now, inflation's been pretty tame. And so when it's going up, people feel inflation might be higher in the future. When it's going down, people feel like inflation might be lower. So the other thing is, it's a really good guide for what's going on in the mortgage market. So if you see 10-year treasuries going up, mortgages are probably going to get more expensive, and vice versa. So right now they're coming down. There's a couple of reasons. Number one, they went from a 0.5% all the way up to 1.75%. So from August until March of this year. So pretty short period of time, a pretty strong run. And they got up to a point where um, if you look at the rest of the world, I mean, actually in Germany, they actually have negative rates where you actually have to pay them money to hold on to your money in a treasury in Germany. Japan's at around 0.1%. So when we got to 1.75%, people start to buy it. And the yield on a treasury goes the opposite direction of the price. So when people buy, the price goes up and the yield comes back down. So part of what's been happening is just the US is ahead of the rest of the world. Our reopening is happening, not all of the world, but a lot of the world. And so we're starting to see some inflationary pressure, and we're seeing the 10-year treasury come up because of that. And then the rest of the world look at that and say, "Oh boy, I'll take it. I'll take a 1.75% because my country's only paying 0.5 or whatever." And so there's kind of this competitive piece that happens. But there is another piece, and that relates to what I was talking about here, in the original section of this particular show, in that employment is in the Goldilocks zone right now. So the growth in employment has been kind of reasonable, and there was some expectation that that might be a problem. And then for a while there, if you remember at the beginning of this year, we had a lot of commodity type things. Like lumber went up 4 times its cost in a fairly short period of time. It's now dropped by 45%. It's still above where it was, but that's happened in so many different commodity areas. So oftentimes what happens with commodities, there's a shortfall because the demand spikes pretty quickly, and then you end up with this situation where they can charge a lot more for lumber, but then when you charge that much for lumber, all of a sudden people find lumber. They're coming out of the woodwork, and that drives price back down. You'll see that oil is going up right now. That's one of the big stories of this week too. Is the oil has come up. We're over $75. But countries like Saudi Arabia eventually look at that and say, "Wow, I can produce more at a higher profit," and so they do. And all of a sudden, oil is at $60 or those types of things. So we are seeing kind of some drop in commodity prices. We're seeing which is a big inflationary piece, and we're seeing a drop in the maybe the unemployment, and employment is in that zone that the market likes as far as that goes. And so if one of the great ways to tell what might be happening with the stock market is really watch the bond market. And the bond market's about 5 times bigger than the stock market. Most people don't know that. And so watching that and understanding as that yield comes down, you'll often see that stock market do quite well. And that's what we're seeing right now, up every single day this week, basically record high closes every single day this week too. So that's what it means to me, is that the bond market is looking at all the numbers and saying inflation is a little bit less likely, coming up here than was thought. And so there's some readjustments on top of the fact that the international market for bonds is paying less as a whole than we were. So that's going to drive that back down too, as people purchase our bonds.
We have about 3 minutes left, so I'm going to just ask one more quick question.
Okay.
What is a stock option, and what are the pros and cons?
All right. So stock option there's a whole, unfortunately, that's more than a 3-minute question, but I'll give you the Reader's Digest version of that as a whole. Essentially, is an option to buy or an option to sell, essentially, a stock, and you can be on all kinds of different sides of that. You can sell them, you can buy them. One of my favorite things that we do is what's called a call option, a covered call option, for example. So somebody owns a stock and we'll go out and sell a call option, which allows somebody else to buy those shares at a price higher than today's price. And if it gets to that price, those shares disappear. But if it doesn't, you just basically get to keep the money. Either way, you get to keep the money from the sale of those call options. But it's a very interesting area. I always try to caution people from trading in that particular manner, because that's what people do now, especially in this particular market. Got a lot of people trading options. It can work really, really well, and I don't mean to discourage people that are good at it, that's for sure. But it can be very difficult to get good at it. It's a way of kind of magnifying your gains or losses when you're basically trading in stock options. For a lot less money, you can get exposure to, say, 100 shares of something than actually buying 100 shares. So yeah, it's an interesting area.
Yeah, the one thing about stock options you should be concerned about is you don't own the underlying or stock. And so the option has the ability to expire.
Yeah.
And so you lose that right over time. So they're not permanent.
Yeah, every single day that goes by, you're getting closer to the expiration date, and essentially the value of your option is going to zero at the end of the time. And so if you're right, the motion upward might be enough, for you in terms of profits to offset that constant erosion of the value. If you're wrong, it just magnifies it because you're losing money every day essentially on an option versus the time. And that's a really good point. It's one of the really good challenges. You could be right, but not right in the right amount of time. So if I buy a 6-month option, and the market finally moves on that stock 12 months from now, doesn't matter. If I own that stock, that probably works. I still have it, and I made my money, and I was right. So yeah, combining it's a lot of things you have to be right on to kind of make money in that area. So they can be fun and what have you. It just doesn't really fit, with the process that I'm using here. I'm managing people's life savings, so that's not something that's other than the covered calls, which are quite safe. Really don't get involved in that too much. All right. So that's our show for today. Again, we're here every Friday from 12:15 to 1 o'clock. I want to wish everybody a happy 4th of July weekend. Actually, this is going to be a really fun weekend, especially now that, things are starting to slowly but surely get back to normal. And again, if you want to subscribe, hit the subscribe button, hit the little bell. These educational videos that we're making will be posted, on a regular basis, and you get notified of that. And then again, please feel free to share these videos, share the link to this live stream, share the link to our channel as a whole, for people that you care about, that you want to have, learn, kids, grandkids, friends, relatives, coworkers, whoever it might be. So really look forward to that. And I want to thank everybody for watching today. Thank you very much.